on TV, online, and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd, and this is Talk Your Book, and today we're very lucky to be joined by Scott Rundell from Mutual Limited. Scott, thanks very much for coming back on the show.
Thanks for having me, Chris.
Now, maybe before we get into a bit of a macro talk today, tell us a little bit about Mutual Limited and how you guys look to invest.
Mutual Limited has two lines to the business. We have 4 retail funds, which start off with a term deposit fund all the way up to a high yield fund, which is roughly around half of our funds under management. And then the other half is a selection of high net worth individuals, APRA regulated entities that need their capital managed, and so on and so forth. So all up, we're just under $3 billion under management, and we focus specifically on debt products or contractual obligations, mainly public. We don't really look at the private loan space for the liquidity elements there, and no equities, and all about stability, safety, security in a rising interest rate environment or a stable interest rate environment.
And you referred to internally as the CIO. I refer to you as the macro guru.
Thank you.
In terms of our viewership, I think what's on the forefront of everyone's mind is local inflation and interest rates. Mm-hmm. How are you seeing those markets, and what do you think's next for Aussie interest rates in particular?
I mean, the inflation story is an evolving one. It is trending lower. That has to happen with the base effect. But as the RBA has pointed out, there's 2 core components to inflation, and one particular component is causing concern is services inflation, which is still rising while goods inflation is falling. That in turn was more driven by the supply chain imbalances caused by COVID. The services element, financials, insurance, tourism, a lot of it around the imbalances caused by labour immobility are still sort of ticking along and a bit hard to gauge. And you add to that the rebound in house prices, which causes another concern for the RBA on the grounds that people feel a bit more enthused or confident to spend money when their houses are going up. So it's all about trying to bring back aggregate demand so inflation's under control. The last print was 6%, targets top of 3%. At this stage, they're forecasting that to be reached by late 2025, which is realistically quite a long way away. So in that environment, where are interest rates? Obviously, for the last 2 meetings, the RBA's left rates at 4.1. Consensus, I think, has one more rate hike in the cycle, which is a camp I'm currently in. It does move around a bit, though, because the data is so fluid. Today, we had wages data. Came in under expectations, flat to the prior quarter and year. So it's a moving feast, and it's a difficult one to judge. But I think regardless of whether we're at the peak cycle now, I think the market has increasingly come to the conclusion, and I think rightly, that we're going to stay relatively elevated for a period of time because it is going to take a while for inflation to get back to target.
And you mentioned Aussie house prices before that have showed surprising strength recently. Albeit on relatively thin volumes. Yep. We got told housing Armageddon was coming as the fixed rate mortgage cliff, which we were due to be entering sort of about now, the finality of that, the fixed rate mortgages that got entered into during COVID. What are you hearing and seeing in the Aussie housing market, and what do you think comes next?
I think when you look at house prices, and I think I was on this show when we were talking about the 20 to 30% decline that a lot of henny penny types were sort of signalling. I think it's important to point out that realistically we've never really had a peak to trough any greater than 10%, and that's roughly what we saw this time around. And what's changed that environment is, we're seeing the cost of building a house is quite high, so building approvals are falling. We're seeing an influx of immigration as those imbalances sort themselves out post-COVID. So 300, 400,000 people coming to the country need somewhere to live. Rents are up. Rental yields are near historical high, vacancies are low. And those dynamics are very supportive historically of house prices, and that's what we're starting to see. You talked about supply. Really, if you don't need to sell, you don't sell. And I think in this environment, we're in that environment where there's a supply-demand imbalance. New supply is not really coming through. Yes, we've seen some construction companies go under, but they're relatively small, 1 or 2 bigger ones. But I don't think tradies are really struggling. I mean, you try and get a tradie to your house these days, it takes 3 or 4 weeks to get someone in. So I think there's still a lot of demand there. And the renovation market's probably a bit more active than, say, the new build market.
And that's the Aussie market. Talk me through, say, the US inflation market and the numbers you're seeing over there.
Yeah, I mean, obviously, US inflation is coming off a lot more aggressively than the local market. It peaked higher, but it's coming off a lot higher quickly. The US market's a little bit different on the housing front, and if you look at, say, the US inflation component versus the Australian inflation component, and US property market's quite different to ours again. So US borrowers are quite incentivised to have a very high loan-to-value ratio because of the tax benefits. Their interest payments are tax deductible. If they make a profit on their house, they're taxed on it. Whereas here, we're the other way around. For our primary residents, we're incentivised to have a lower loan-to-value ratio. So that influences the whole inflation dynamic. Also, within the inflation component on housing, they use sort of an implied rental number, what the rental equivalent is of you owning your own house. Whereas here, we don't have that. We have more, all right, what's the actual rent for those who rent? And then there's the other costs of housing, so new builds and the like. So it's different dynamics, both running pretty aggressively, around 7 or 8%. So both showing growth in prices. And if you sort of chart US month-on-month house price growth versus ours, it's reasonably highly correlated, believe it or not. The
big difference between interest rates in the US, because I speak to people and they say, well, we've got to go a lot higher with our rates because look at where the US are.
Yep.
If you look at US homeowners, the vast majority of them are in 30-year fixed loans who aren't being touched at all by these rate rises. If anything, they can put surplus cash in money market fund and use that to pay down their mortgage for principal and interest. Do you want to just maybe explain just how high a percentage of US homeowners have fixed rate mortgages and why the reaction function of rate rises may not be as strong in the US as it can be here?
It's a very good point. And the RBA does have that ability, and the RBA increases rates, and then within 60 to 90 days, your mortgage goes up, typically. And in the US, to your point, 95% of Americans have their mortgages fixed for 30 years on average.
Which wasn't the case in the GFC, was it? It's much higher than that. There was a chunk, but it wasn't as high as this in the GFC, was it?
No, but the other element with the GFC driven was the regards to, in Australia, when you have a mortgage, it's full recourse.
Yeah.
The American system, we've heard the story, jingle mail and ninja loans, no income, no job, no problem sort of thing. So in those instances when the property bubble did collapse or did explode, a lot of people just threw the keys back. Whereas here you fight tooth and nail to keep your house. So that's why the banking dynamics is different as well. So so 95% fixed, 30 years, and that can be an impediment to turning over stock as well, because if you're locked in the last 2 or 3 years at a really beautiful rate, you're probably less inclined to sell out, because if you're refinancing, you're going to be refinancing at a higher rate. Whereas here, the latest statistics were about 30% fixed, and only for 3 years on average, if that. So, and the mortgage cliff is coming off, as you alluded to. Most of the signalling from the banks is that they're not seeing any material deterioration in those loans versus, say, the broader book. And I think that's maybe a reflection of the type of people who did lock in. You could suggest that they were more financially savvy, a bit more educated, a bit more financial resources, and utilise the circumstances to fix their loan in, so that when they do come off, it's not as big a shock for them, and they expect that it's coming. And the banks have been very good at telegraphing and signalling to these borrowers, hey, your mortgage is about to change. So there shouldn't be any surprises.
We'll dig in a bit more to the US data when we come back. We'll have more Talkie Book for you right after this short break.
On TV, online, and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
You're watching Talk Your Book, and we've got Scott Rundell from Mutual Limited. Scott, we're talking about US inflation numbers and housing market. You mentioned that US inflation is trending down strongly, as it is in Australia. Is it too early for Jerome Powell in the US to do a victory dance around inflation?
I think it is. I think when you look at the journey we had to get to this position with regards to inflation, we had a lot of shocks to the system that we really haven't had before. So to utilise the butterfly effect, we're still learning and still sort of seeing how the ramifications of the COVID and the economic lockdown and all the imbalances it caused with regards to capital mobility, labour mobility. So I think I wouldn't be doing the victory dance. Not that I think the Fed board do much dancing, but I think, yeah. And the other element, we're starting to see increasingly or potential flare-ups is energy again.
Yeah.
We're seeing oil prices up over 20% in the last few weeks. We're seeing signs of gas prices in Europe. Obviously, the situation in Ukraine hasn't really improved. If anything's getting worse. So heading into the European winter, gas prices going up is a threat to European inflation, at least, which has sort of broader ramifications. And then we're seeing more locally the gas workers striking for higher wages and causing some potential supply disruption. So I think there's still some components that can cause some flare-ups. And I would suggest that the final, so while the US has gone from, say, 9% down to sort of 3.5% range, targeting their 2%, I think that final 1% could really take a while to come through and be that really sticky element. Their labour market's still showing signs of strength. Wages are still very strong. The consumer's still spending. So I think there's a lot of componentry within the financial plumbing of the world that has changed since the last time we had an inflationary cycle. And I'm the first to say there's a lot of complexities there in capital movements that just really hard to judge and gauge. You know, from the GFC to now, we've seen the Fed balance sheet reach $9 trillion. It's still 8 and a bit. What does that do? Interest rates historically are still very low when you look at where it was pre-GFC and so on. So it's too soon to do the dance.
Do you look at interest payments that they're now going to be paying on newly issued bonds and T-bills and charging towards $1 trillion a year?
Yep.
And looking at their deficits, which is it 8% of GDP now?
Sounds about right.
And we're not even in a recessionary environment.
Yeah.
Do you look at that and think, gee, that feels unsustainable once a recession eventually does hit and your deficits are already so large? You're
right. It isn't unsustainable. And we've been talking since the GFC about kicking this deficit can down the road. The debt ceiling's always brought up, and it's always, I think from mine trying to think what's the next interest rate regime, what yield structure are we looking at? Now, if you look at pre-GFC, using Aussie yields, 3s and 10s were roughly between 5 and 6%. Somewhat consistently then the GFC happened, and we sort of dropped to a 2 to 3% range, and then, 3 to 4% range. Then we had post-European crisis 2 to 3% range leading into the pandemic. And said, okay, what's next? We hit zero effectively. Now, do we go back to the 5-6 range? Do we go to 3-4? And I think 3-4 is the most likely, given to your point about the debt. It's not just the US government that's levered. Households, businesses, governments around the world have spent billions and billions, trillions of dollars to support their own economies during a systemic shock of COVID. So the world can't afford 5 to 6% yields as a proxy. So I think we will settle around these levels, and how we get there is the unknown. Will we have the Fed could we'll just leave the balance sheet there for a while because it's in our interest as a government to have lower debt, given we've got so much to fund.
And you mentioned owners' equivalent rent in how they measure shelter in the US, which I think is a homeowner basically saying what they think their house would rent for if it was on the rental market. Yeah. It seems an odd way. Yeah, it seems an odd way. Certainly in the 70s it was different, and their inflation numbers were, I think it was just house prices in the 70s.
A bit before my time. But.
Yeah, a bit before my time. Anyway, it's measured differently in Europe, which could mean that their inflation actually comes down quicker than the US if they follow the US's path on the other inflation data points. Is that something you're following? And could that mean Europe actually cuts rates before Europe, which would be a non-consensus view at this stage?
Yeah, I mean, I think Europe is sort of a blend of what we have here in the US, in that they look at land, for example, as an investment, so therefore it's not factored in, whereas utilities for owning a house and the like are. It's a plausible point, and I think if you look at Europe as well, with the conflict on the border and all the ramifications from that perhaps they do need to stimulate their economy more aggressively sooner. But having said that, I think the ECB can be a little bit more stick in the mud vis-a-vis policy mobility and may be inclined just to continue to stamp on inflation more aggressively. So it is an unknown, and it is one for further debate. But right here, right now, I wouldn't say I'd be on board the ECB going sooner than the Fed.
Scott Rundell, thanks so much for coming back on the show.
Thanks, Chris.